What's up, everybody? Welcome to another episode of Real Estate with Gav. I am your host, Gavin Washington, aka Gav the Realtor, and today I got a special guest with me, Mr. Kendell Burke with Homespire Mortgage. He's going to help us break down how we can afford a home, how to get a good home loan. So, Mr. Kendell, welcome, and how you doing today?
Good, Gavin. Thanks for having us.
Yes, sir.
Great opportunity to be here to explain some great things to buyers about how they can become new homeowners.
Yes, sir. Yes, sir. So before we dive into pre-qualifications and interest rates and home loans and all that good stuff, tell us a little bit about, your position and a little bit about Homespire.
Yeah, so Homespire Mortgage has actually been in the Eastern Panhandle for the last, we've been here 7 years now. My position, I'm a producing branch manager with Homespire Mortgage, meaning I not only run the day-to-day of the branch, but also produce, meaning I do home loans for people still. A lot of times you'll see a lot of branch managers, they don't get involved in the day-to-day of actually producing loans. I love that side of the business, so that's why I still take on those tasks of really helping clients achieve home ownership.
What's your take on the current market right now? I know a lot of people are seeing some uncertainties. Last year there was a really hot market, and then it kind of slowed down as the interest rates crept up a little bit. What's your take on where it's at right now? And is this year a good time for people to buy a home?
Yeah, so my big mantra right now for clients is short-term pain for long-term gain. A lot of people ask me, what in the world, Kendell, are you talking about? So the interest rates are up a little bit higher right now.
Mm-hmm.
And with those higher interest rates, your payment is going to be a little bit higher.
Right.
So what that means is for you, let's say we go 6 to 8 months down the road here, and the interest rates do come down a little bit. What we're looking at is, I had a client the other day, their payments at today's current market rates are roughly around like $1,700. And then, Kendell, we really want to be around the $1,500 mark. So I kind of look at peek into the future. I say, okay, here, client, let's take a look now, 6, 8 months from now. And let's say the rate was 2 points lower. In this instance, we were like 6.5, and we looked at a rate of like 4.5. Well, that payment at 4.5 was right where they wanted to be at $1,500 a month.
Mm-hmm.
So therefore, the term short-term pain for long-term gain. And now what that means long-term for that client, they are still actually gaining equity in that home
Right.
in the long run. So year in, most clients are going to gain anywhere from 5 to 8% equity.
Sure.
So if you can handle the short-term pain, meaning a little bit higher payment today, you're still going to gain that long-term real estate investment of equity in that home.
I like it. So as a realtor, when people come to me, my first question usually is, are you pre-qualified? Are you working with the lender kind of thing? So if I'm coming to you as a first-time home buyer, what is the steps of pre-qualification or pre-approval, and what documentation do I need to get that started?
Yeah, so the number one thing we want to focus on with the client is actually getting the application, and we walk them through that step. A lot of people think that's one of the most daunting tasks because maybe they don't remember, this and that about their past, whether it be their residence, where they worked. So we're going to walk through them step by step to gather that application. Once we have the application, and we are gearing to look at 3 main things. Number one thing, we're going to review credit with that client. We want them to understand their credit history. Number 2, we want to review their income. By reviewing income, we're looking at, how long have they been at their current job? Can we use overtime income? Do we have to just rely on their base pay? And that all comes with that review of their income through pay stubs and W-2s. And if we need to, we even look at tax returns.
Okay.
And the last thing we want to look at is going to be assets. And assets is kind of a tricky one because not every loan program requires a down payment. But let's say we've got some spots maybe on our credit that we can overcome maybe with some assets. And most people think assets are only how much money I have in my checking and savings account today.
Right.
Not necessarily. We've got clients, especially in our area, who have worked at their jobs for year after year, and they're putting money into a retirement account that they don't even consider an asset because they might be only, a certain age, so they're not even thinking about retirement.
Right.
But we can throw in those assets such as retirement, and it might take a file that's not approved and turn it into an actual approval because the system will look favorably on their assets. So those are things. We want to really dial in and review credit with the client. We want to definitely review their income. And then the last thing we're going to want to review is those assets with them.
Okay. So when it comes to credit, I get this question sometimes. Do you actually have to run my credit? And then with that, is the credit score for buying a home a little bit different than like buying a car for sale?
Sure. So we do have to review credit. When I say review credit, Yes, we are going to pull an actual mortgage credit report. It is a tri-merge report. So we're going to pull all three major credit bureaus, TransUnion, Equifax, and Experian. Is no different than the report of buying a car. Most car dealerships will actually only pull one report, and that's just who their lenders use as their source of credit. So let's say I was down here at a car dealership. That car dealership uses Experian as their source of credit. They use that source of credit because their lenders use that as their source of credit.
Gotcha.
Us, we want to look at all three bureaus because we need to see a deep dive into credit. And then how the score actually works is we're going to have three scores. Your qualifying credit score is going to be the middle of those three scores. So if we've got a 680, a 690, and a 700, that 690 is going to be your qualifying mortgage score.
Okay, good to know. Good to know. Another term I hear a lot of lenders refer to is what they call debt to income, or DTI. What exactly is that, and how does that play a role in your pre-qualifications?
So what we're going to go back to is when we review that income, we're taking their income in relation to the review of their credit. And when we review credit, we're pulling in any debts that they currently have. So let's say they've got a car payment, they've got student loans, and they've got a couple credit card debts. What we're looking at is their income. Let's say they have an income of $2,000 a month. Most mortgage loan programs have a debt to income ceiling. Maybe, if we're looking at a conventional loan, that ceiling is 50% of your total monthly debt is all that their guidelines will allow.
Okay.
So what we're looking at is, okay, we've got a $2,000 a month income, $4,000, wherever your example would be.
Right.
Conventional financing will only allow me to take all of their credit debts, their car payments, their credit cards, their student loans, plus my new mortgage payment, and will only allow us to use 50% of that gross income.
Okay.
So,
Okay, that makes sense. So let's get into a little bit about the different loan programs. I know one thing that I get a lot of people don't realize the different programs that are out there for whether you're a first-time home buyer or a second or third time. And a lot of people still think that 20% down is what you have to buy a house. So let's start with a couple of the government loans, in particular, FHA. Tell me a little bit about the FHA loan, the qualifications for it, the down payment, and so forth.
yeah, so FHA was actually a program created. I would give you the year, but it's been years and years ago. And the program was actually created to open doors for more home ownership to people. And what I mean by that is they will actually accept lower credit ratings. They accept a low down payment of 3.5%.
Okay.
And these loans are backed by the government, meaning if a client were to default on those, it actually makes the investors more apt to do these loans because they're backed by the federal government.
Right.
So in these loans, they also will take a little bit deeper dive into like employment history and so forth. So they're a little bit easier to access, but you've got a little bit more stuff that we want to track to make sure when they're doing these government-backed loans that the clients are fully vetted.
Gotcha.
They're a little bit easier to access.
So as far as lower scores, what type of lower score could I have and still get approved for an FHA loan?
Yeah, so right now, the lower end of scores is going to be 580.
Okay.
Could that change at any point? Yes. So that's going to be really dictated by investors. So with us at Homespire, we've got 27 different investors that we use. Those investors actually set those floors when it comes to credit score.
Okay.
So right now, Homespire's floor is at 580 because we have investors who will do loans for people down to a 580.
Okay.
Now, FHA in general, they actually will go down to a credit score of a 500. Now, with the market that we're in, with different investors pulling back in certain areas, you're seeing a little bit more. To talk about market conditions, that's one of those market conditions where investors are pulling back on some of those riskier loans, and they're only doing down to scores of 580. But let's say the market conditions change and you had a score of 525, and we were able to get your income calculations correct and everything, you can actually still be approved for an FHA mortgage.
So I don't have to have a 700 credit score?
Absolutely not.
Okay. Well, what about the USDA loan? I want to talk about that a little bit because that is a no money down loan, correct? Correct. So what's the qualifications for that if I'm looking to come with no money down, and what type of credit score might I need to have for that one?
Yeah, so the number one, and I wouldn't even call it a restriction, but guideline that the USDA sets forth is that the home must be in their geographical footprint. In our area, let's just take Berkeley County, for instance.
Okay.
There's only a small pocket in the city of Martinsburg that would not qualify for a USDA mortgage because of location of the home.
Got it.
Okay. When it comes to credit score, the USDA, what most people don't know is they set a guideline of a 640 credit score, but they allow for manual underwriting if your score is under a 640.
Okay.
I'm an example kind of guy. So let's say we take a look at a client several weeks ago and his score was a 622. He had 2 years on the job. He had good income. He checked all the boxes but the score.
Right.
USDA gives those people what I would call almost like a second chance, where they will allow you to take in compensating factors to do that lump. So there's not a hard line at 640. As long as we can provide some compensating factors, USDA will kind of work with those clients because they want people to be able to afford home ownership.
Okay. Cool. Now with USDA, is there like an income limit that goes, like for our area, for instance, what's the income limit?
Yeah, so if we're in Berkeley County, the income limit is $103,000 and some change.
Okay.
They have what's called high cost areas, and those areas, so think like Loudoun County and even counties that border Loudoun County in our area, like Jefferson County, Clark County, Virginia,
Right.
they have higher limits. So you can go up to almost $125,000 and some change.
Okay.
And these are for a family of 4 in those counties. So let's say you had a family of 5. I've got 5 kids, and that would be a family size of 7. The more people you have in your household, the higher the income limit is. Now, they do account for the whole house income. So let's say your wife and you were thinking about purchasing a home,
Right.
and you were the only one on the loan. Your wife has income, we would account for the whole household income.
Gotcha.
Same thing, we had any other family members in the house that had income as well.
Okay. Another government loan that is geared towards our military people, the VA loan. Talk a little bit about that. And do you have any other qualifications that you have to meet besides being a veteran to get that loan?
Yeah, so whenever we speak with a veteran, the first thing we want to do, the VA makes it actually very easy for us. They give us access to their portal to pull certificate of eligibility. So when a client comes to us and they have questions on, do I qualify? Do I have a funding fee, which is part of the program? We're able to access that information, within seconds for them.
Mm-hmm.
So we don't have a question saying, do I qualify? Do I not qualify? And we can answer that question very quickly for those veterans. Most of the time, in my experience, any veteran who has served active duty, even though they're not active duty today, they do qualify. The only question that we run into, especially in our area with the Air National Guard, is we have some reservists, and there is year of service requirements. I believe it's 3 years.
Okay. Now, for the veterans, do they have like a minimum credit score that they need to have to get qualified?
Yeah, so the VA does not have any overlays when it comes to credit score.
Okay.
So, those 580s coming in range, we do come back into play to where we're talking about investors. So it's just going to depend on if you've got clients who are, have those compensating factors with the lower scores.
Right.
So there is no overlay from the VA that says, hey, the credit score must be at this level in order to qualify for a VA mortgage. And the debt to income also has no ceiling on a VA mortgage. That you have the highest debt to income, limits that you can have on any loan.
Okay.
I had a client the other day. Most loan programs will only go up to 57% debt to income, meaning, you can only take up 57% of your income towards your bills and your new mortgage payments. VA has no overlay.
Okay.
So if the system takes it as an automated approval and you're at 60% debt to income, we can do that loan for you.
Got you. Okay. Now, the conventional loan, this one seems to be, for most people in the field, they call it the holy grail almost. It's supposed to be the best loan type. Why is that, and what are the different qualifications for that?
Yeah, so most people, when they're thinking conventional loan, they're thinking higher credit scores. So what that translates to your point is, especially in the market we've been in for the last year, 2 years, when people were really setting the standard at conventional loan was, they thought of conventional loan buyers, as more responsible buyers. Number one, they had higher credit scores.
Mm-hmm.
Number two, they always had a down payment,
Right.
because conventional loans are going to require a down payment. So therefore, in the minds of the sellers in a very competitive market, they were looking at those conventional buyers as the most responsible, stable buyers for their home.
Okay. And what type of credit score would you need for a conventional loan?
So 680 is kind of the starting point.
Okay.
Then we go lower. I always use the term compensating factors. Yes. Let's say we've got a client that's a 650 and they've got 20% down. Obviously, we would want to take them conventional in order to take advantage of no mortgage insurance and stuff like that.
Right.
But the 680 is usually the starting point that when we start looking at clients with down payments, we want to look at about a 680 credit score.
Okay. But with the conventional loan, you don't necessarily have to have 20% down.
Absolutely not. Yeah, will go, standard conventional loans will go down as low as 5%.
Right.
And that's going to be for someone who's never owned a home in the last 3 years.
Okay. Now, Homespire, if I remember correctly, I think you guys actually have a conventional loan program where you can actually put 3% down. Is that correct?
Correct. So we want to open up home ownership for more people as well. So we have a program for first-time home buyers that they can actually do a conventional loan, put 3% down, and that 3% down program actually offers a discounted mortgage insurance rate. So therefore, we're opening up a lower payment for them, lower down payment for those clients.
Wow. So if I'm in good standing, I could potentially get a conventional loan and put less money down than even an FHA loan.
That's correct.
Yeah. So that's very good to know. Are there any down payment assistance programs that could be out there for people that are looking to, getting a home ownership for the first time?
Yeah, so we've got a couple of different avenues. The number one avenue, especially in our area, there's a HAP program. HAP program was actually going to be, it's a down payment assist program, but if you were to stay in the home for 5 years, the down payment assistance actually goes away. So it turns into almost like a grant.
Okay.
Now, we also have other programs. It's a weird name. It's called Genoa. Most of those programs are through FHA, but it would allow you to take that down payment and actually finance it in a second mortgage. Now, they actually have forgivable seconds, and then they actually have payment seconds. And what I mean by forgivable seconds, same way as the HAP program. Let's say you were to stay in that house and make your payments on time for 3 years. That down payment assist program, actually, the loan goes away and they forgot.
Sure. Okay. So now we know a little bit about the different loan programs, the different down payments we can get into. What is the current average interest rate that somebody might be looking at?
Yeah, so rates obviously change daily.
Right.
And so when I come into my office every day, about 10:30 every day, we can pull up a new rate sheet, and that rate sheet is going to be tailored to whatever loan file we're working on, because it'll only pull me rates for maybe a particular loan program or a particular credit score, particular down payment. So those ranges in rate, and I always give a client a rate range or a pre-approval phase because of the changes in rates.
Right.
But today's market rate, you're probably anywhere from 5.5% all the way up to 7%, depending on your situation.
Okay. Is there any way that I can reduce my interest rate or like buy down a point or anything like that?
Yeah, so this is a real good question in today's market. Excuse me. So here's what we want to look at in today's market. So I'm going to take it all the way back to our first question when we talked about short-term pain for long-term gain.
Right.
There is a way to reduce the rate, and it's by buying discount points. Okay. Discount points are an upfront charge that is non-refundable on your closing cost. In today's market, it's not the most advisable thing to do, only because the potential for refinance is not too far down the road.
Right.
So if we're taking a client and they were to buy one discount point, and let's say it lowered the rate 0.25%. Well, let's say they were only to save $24, $25 by that rate going down that little bit. They would have paid on a $200,000 loan $2,000 in discount points in order to gain that advantage in rate. My advice, it doesn't make sense every file to do that, because let's say we go 6 months from now and the rates drop to 4.5%, you're going to end up refinancing that loan anyway. Those discount points that you paid to save $24 a month, it's going to kind of go to the wayside because they're non-refundable discount points. So we want to put you in a good situation. We want you in a good payment, but we also want to put you in a good financial situation to where we're not, you're not being charged fees for discount points to where it's really going to be a moot point 6 months, 8 months down the road.
Right.
But we're going to be 2 points maybe lower in it.
Okay. Yeah. So once I get pre-approved with you and I get my interest rate, how long do I have to buy a home, and can I lock my interest rate in?
Yeah, so a couple different things there. So when we do a pre-approval, documents will expire after 30 days. And what I mean by that is the worst case scenario, let's say it takes you 35 days to find the home of your dreams. We're going to need maybe an updated pay stub to prove that, hey, we're still making the income we were making during the pre-approval process. But our credit reports that we pull are actually good for 120 days. Okay. So you get a long time really to look for a house with that same credit report before we have to start updating credit scores and credit reports and so forth like that. The other thing and then we want to look at during that time period is to kind of keep everything the same. We don't want to go out and add new debt because there is, when we do a mortgage, and there is going to be what's called fraud reports and so forth. So that information is going to come out. So we don't want to go buy a car. We don't want to add debt that could change your situation. But as far as your pre-approval, as long as we kind of fall within that 120 days, worst case scenario, I'm going to ask you maybe for an updated pay stub.
Okay.
This time of year is kind of a hot button because we're switching over from a new year. So let's say we get into the end of this month, we're probably going to ask you for an updated W-2,
Right.
because we just changed over from 2022 to 2020.
That makes sense. We got you. So we talked a little bit about the cost as far as down payments and things like that. I want to get into a little bit of outside of the down payment, specifically with loans like USDA and VA, because what I've learned from past clients is a lot of times they think no money down means I can buy a house with literally nothing out of my pocket, but that's not usually the case. So one expense that usually comes up is an appraisal. So what is an appraisal, and is that something that I have to pay out of pocket?
Yeah, so an appraisal is going to be paid out of pocket for the main reason that an appraisal is actually your appraisal. So Gavin, you're the client.
Right.
We're under contract and we're moving along with your loan terms. We're going to order the appraisal as the lender, but you're going to pay for that out of pocket because it is your appraisal. It is basically you justifying your loan that it meets the value of the contract price that you set forth with your realtor.
Gotcha.
Now, there is a caveat to that. Let's say, on a USDA loan, in today's market, a client is getting some seller credit. That money can actually be returned to the client at closing as long as we can source it.
Okay.
So if there was, you could include that appraisal fee as part of your seller credit closing cost out from a seller.
Okay, but typically your appraisal isn't wrapped into your loan. Gotcha. Okay. Good to know. Good to know. What is closing cost? Like, what all is involved in closing costs? What, a lot of people hear that all the time. They're like, who am I paying? You know what I mean? So what exactly is that, and how much could you look forward to paying at closing?
Yeah, so on a closing disclosure, you're going to see probably 5 or 6 different boxes.
Mm-hmm.
You've seen the closing disclosures. Number one box that you're going to see on a closing disclosure is going to be lending fees. And there is going to be fees associated with originating a mortgage. We've got underwriters who are going to underwrite your file. We've got processors who process your files. So those are fees that as a lender we do charge to offset those costs as a lender. The other thing, the next thing you're going to see on there is going to be any type of fees that are going to be set forth, whether you're closing with a title company or whether you're closing with a closing real estate attorney. You're going to have their fees. And their fees are they're going to be their same kind of fees as ours. They're going to have doc prep fees. They're going to have processing fees and so forth. And then you're going to have to pay Uncle Sam and your local governments, because you're going to have the next set of fees is going to be your local taxes. So just like if you were going to the store and you're going to buy a loaf of bread that's got sales tax on it, your real estate transaction is going to have sales tax on it as well. So that's going to be calculated in your closing disclosure. And then the last thing is going to be prepaids. A lot of people don't understand that when we close a mortgage, we've got to have things in order for the next year. And what I mean by that is you're going to close your mortgage. Let's say today is, we're in January. Mm-hmm. You're going to have a new home insurance bill come due next January after you've owned that home. So what we want to do is we're not only going to pay for the first year of insurance up front, but then we got to collect enough money to pay for the next one that's due. So we're going to have those prepaids for insurance and taxes. Now, to that long-winded answer, your total closing costs, I would say in today's market, I used to have a good rule of thumb at 3%. You're probably more apt to jumping up to about 4%.
Okay.
Probably because the taxes are going up, insurances seem like they're going up, and just unfortunately real estate fees in general seem to be climbing a little bit higher, just like inflation or anything else. They've gone up a little bit.
Yeah. So that's like 4% of the sales price.
Correct.
Could be looking at for your closing costs. Yep. Okay. Now, is there any way that I could get out of paying closing costs? Like, can I wrap that into my loan or ask somebody like the seller to cover it?
Yeah. So absolutely. Seller credit, meaning the sellers of the property are willing to contribute to your, as the buyer, closing cost, is your number one easiest path to having some of those closing costs paid for you. There is instances where it can be wrapped into the loan. But they're not tricky. But let's say the appraisal comes back high. And what I mean by high is, let's say we have a contracted price of $200,000. The appraised value comes back at $215,000. We've got $15,000 of that house is worth more than your contract price. We could, especially on a USDA loan or a VA loan, add those closing costs into.
Okay. That's good to know. Good to know. Now, what are some things, this is a good question I get a lot too. What are some things that you should not do once you get pre-approved to buy a home? Like you're getting ready to put an offer in and you don't want to mess up your credit and all that good stuff. So what are some things that you absolutely should not do once you get pre-approved and you're about to go find some keys?
Yeah, so then the number one thing, and most people don't think of this, most people think of it as, oh, don't go buy a big purchase such as a car or furniture or whatnot. Mine is actually, little bills. Let's say you moved from one apartment to another apartment and you had water service at that old apartment. Most people don't think, when you leave that old apartment, there's a final bill. Right. Sometimes that final bill doesn't get, paid. Well, it can catch up to you months, years down the line. So you really want to pay attention, I would say, to the small details, such as medical bills, like I said, old maybe utility bills, because those are things that tend to creep up on people after we're already in the process, meaning, that company has tried to collect, where all of a sudden they file a collection with a collection company, and there's nothing worse than being in the middle of being pre-approved and under contract on a house, and we get a ding saying, hey, there's a new collection, and it either needs to be paid, it needs to be explained. It just creates, a little bit more of a, complex situation. And the next one we talked about is no large purchase. And sometimes these can be overcome. So, you can't, make life stop. Let's say we had a car and the car breaks down, we had an accident, whatever the situation is, just run it by your lender, loan officer, and say, hey, my car was in an accident, I've got to go get another car. We can advise you saying, hey, we were already accounting for a car payment of $400 a month. Right. Just stay within that window and your pre-approval is going to stay the same. Where we run into issues is someone takes a $400 car payment, goes and trades it in on a truck, and now they got an $800 car payment, and, we're not in pre-approved range.
Gotcha. So definitely just continue to pay in there.
Communicate. Talk openly with your loan officer on any financial decisions where you're going to add debt to your debt.
Gotcha. So if I have bad credit and I know I have bad credit, should I still come to you? Is that something you can help me with?
Yeah, absolutely. Because most of the time, people they want to self-medicate their credit. And what I mean by that is there is a lot of good resources out there, such as Credit Karmas and Experian Boost, and they do give you some valuable knowledge. But what we want to do is when we actually pull in and review credit, we want to give you the quickest way possible to get that credit up.
Right.
Most times you'll look at your own credit report and you'll review it and you'll say, oh, I got to do these 10 things, and you kind of take yourself out of buying a home because you see 10 things there that you think are preventing you from buying a home. When we look at it, we want to run those score simulators, and I had one the other day where the client, the only issue they had done everything right, is they had a credit card that they had opened to establish credit, but they never used the credit card. We actually can put a balance on that credit card, like to see what the score would do with a balance. Their score went up 80 points by just putting a balance on their card and activating the account.
Wow.
And they thought they had to pay off 10 other medical bills to get to being able to buy.
Gotcha. Is there a certain balance that you like to see on credit cards?
50% is always kind of the rule of thumb. If we can keep those balances under 50%, the credit bureaus look favorably on that as a responsible consumer.
Got it.
So 50% is always kind of a good rule of thumb.
Okay. So a lot of good information. Just like realtors, there's a lot of lenders out there that, that all do a little bit the same stuff like what you do. If I'm a new person trying to buy a home for the first time and I see this video, why would I want to reach out to Kendell or Homespire, and what makes you guys a good company to roll with?
Yeah, so my number one attribute when working with new clients, even repeat clients, is communication. I try to set myself apart by time blocking my day. So a lot of people know, especially in my office, when they come in and it's 9:30 in the morning, my door is shut. And the reason why my door is shut because I have calls to make.
Right.
And those calls are not only to whether it be a realtor to update that realtor what's going on with their client, but also to clients, because we want to give you an update every single week. Because the number one complaint we found of clients was, I don't know what's going on.
Right.
I don't have a clue. and then that translates to you as a realtor, and it just runs downhill. And what we don't want is the client that doesn't know where they're at in the process and have a clue of what's going on, whether they're under contract, pre-approved, credit repair, wherever they are in the process of buying a home.
Right.
We want to communicate with them in a way to where they always understand what's going on. So
I like that. I like that. Communication is key. One of the many reasons why I'm always having this. So I appreciate you. Well, there you have it, folks. That's Mr. Kendell with Homespire. He's dropping knowledge for us today. If you want to reach out to Kendell directly and ask loan-related questions, Mr. Kendell, how can they contact you?
Yeah, so number one thing, you can always just stop by our office. We're always there Monday through Friday, 8 to 5, 1008 Winchester Avenue here in Martinsburg. We're actually right across the street from awesome seafood restaurant, Mother's Doctor. So you can grab something to eat and get a mortgage all in the same place. Also, if you're reached on my cell phone, I always answer my personal cell phone. It's 304-886-8821.
Perfect. And if you reach out to him after watching this, of course, make sure you tell him you heard it from Real Estate with Gav. And as always, if you need help in the real estate market, whether buying, selling, or investing, you can reach out to me. I'm on all social platforms at Gav the Realtor. That's GAVTHA Realtor. Or you can hit me on my direct cell phone number at 304-839-7040. Thank you all. Thank you again, Mr. Kendell, for coming through. Appreciate it. Looking forward to working with you some more. And everybody else out there, stay up and stay blessed. Happy New Year. Peace.